please welcome our panel, which will be introduced and moderated by former Bloomberg reporter and author writing a book on Ethereum, Camila Russo.
Hello, everyone. Thanks for coming to our panel. I'll have our panelists introduce themselves now.
Hello, everyone. My name is Tanner Hoban. I work as a director for ConsenSys Capital, working on the Digital Assets Initiative, and I've done quite extensive work on ETH 2.0 economics and its longer-term sustainability.
Hey guys, Tom Shaughnessy at Delphi Digital. We do institutional crypto research. That's my 2 cents.
Ryan Selkis, founder and CEO of Messari. We're a crypto asset research and data company. Excited to be here.
Okay, let's get started. So the biggest issue right now for Ethereum is the path to ETH 2.0. So until we get there, there's some time and development to get done. So during that time, will ETH 1.x be enough to keep people on Ethereum, or will people start switching to other chains? Tanner, what do you think?
So the amount of infrastructure and developer tools that have been built on Ethereum is, to a great extent, extremely hard to compete with compared to other smart contract platforms. And what that provides is a competitive advantage and almost as an incumbent to the smart contract space. And it's almost as if Microsoft back in the late 1990s, when they had a great deal of market share with the computer operating systems, that it's tough to compete against that. And ultimately, us as the end users are we are the ones that use these applications, but the applications are built by the developers who choose the smart contract platforms that are underneath those platforms. And if I was building an app as a developer, I would want to consider what would be the the platform with the longest longevity, and that would be sustainably longer term. And with that, I would build on something with a great deal of research and development into the platform, as well as a platform that is sustainable. So my answer to that question is it's extremely hard to compete with something such as Ethereum, even though that it's taking a little bit longer to build out some of the robust capabilities that it's building out.
Right. It's been tried and tested, and it has a big community. I guess the question is, if better tech comes along, will the first mover advantage win before Ethereum gets to that better tech, right? What do you think, Tom?
Yeah, I think Ethereum 1.x has the lead. I think people discount how much of a lead it is, because the fact is that if you're building on another smart contract platform, you have to rebuild all of the infrastructure building blocks Ethereum already has. You have to rebuild all those development teams, all those things that lead to composability lock-in and the ability to build real applications. So even though another smart contract platform may have better tech, Tezos has great tech that's better in Ethereum in a lot of ways. Polkadot will hopefully have some really interesting tech, but it's not live yet. And there's other platforms that make trade-offs that make it better in different respects. But the point is, the time differential between having Ethereum now and having teams built on it versus those platforms then going live and having to attract those teams and developers, I think is much longer than people assume today. So Ethereum, I think, has the lead, but it's also Ethereum's race to lose. State rent is an issue. They have to figure out pruning. They have to make sure that the network can actually last until you get to Serenity. So that's a big what if and a red flag that the teams have to address and work on over the next 2 years.
Yeah.
You want me to just follow on? One thing that I feel pretty strongly about and have for a while, Ethereum's kind of going through a similar situation to what Bitcoin did a few years ago, where I think the community of developers is going to have to decide what's most important for that protocol to win. 1.x is interesting because if you think about Ethereum as programmable money and the fuel for decentralized finance applications, that's probably good enough, right? That's replacing the entire global financial system potentially with smart contracts. So I think about a lot of the conversations now with the Web3 thesis, right? How do people create applications where they take ownership of their data or develop these high throughput systems where you decentralize all of these other applications and marketplaces? That's interesting to me. I think in 5 to 10 years, we're so far removed from that being something that's important to most people. But decentralized finance is important. It's high dollar value relative to Web3 applications. And you can see Ethereum right now being used as a settlement layer for those transactions, much like Bitcoin is becoming a settlement layer for high value store of value transfers, much to the chagrin of some people that want to increase the transaction size and throughput. But I think that's an important distinction, and Bitcoin at least made its decision, for better or for worse, that they were going to cap transaction throughput, focus on security, and then let other layer 2 applications emerge that facilitated smaller payments. For Ethereum, my bet is that it ultimately becomes the DeFi chain. That's the winning outcome for Ethereum. And everything else ultimately lives on either its own chain or is interoperable with another blockchain via Polkadot or Cosmos or some of the others that Tom had mentioned.
And for you, is Ethereum 1.x good enough to sustain this DeFi or decentralized finance layer?
It is already,
yeah.
Right? I mean, it's been working. If you assume that the gas fees are high enough and the transactions are valuable enough and the pain point is acute enough for someone to use a decentralized finance application instead of a centrally managed finance application, which is what most of us are used to anyway, then the natural limit of how much you're going to want to put on chain will come into balance, and ultimately you can run any number of lending applications, derivative applications on Ethereum as it stands right now. Now, you might not be able to trade digital cats, but who gives a shit, right? That can live somewhere else eventually, unless they're really valuable digital cats, like we saw in the run-up, in which case, yeah, you might be willing to pay the fees to actually have that settle on chain. So I think, people talk about throughput a lot in blockchain ecosystems in general, and I always think that it's A, premature, and it's B, a little bit of a joke because no one's actually using these things yet. I actually think that when someone's willing to pay fees to put some transaction on a blockchain, it's a good indication that the application is actually useful versus just marketing driven.
Okay, so maybe it's not such a bad thing that the full scaling won't come till a couple of years from now. Okay, so we've been talking Ethereum versus other, the rest of the smart contract platform world. What about Ethereum versus Bitcoin? If you have $1 million, would you put it on Ethereum 2.0 or Bitcoin? For those who can't talk about investment, Tom or
Sure, I'll start. I'm a old finance guy. I actually used to work alongside Tom back in the day. But so with that said, I'd probably put it into some small cap stock that I've been researching. But if I had the choice, I'll tell you what I wouldn't put it in, and that's probably Bitcoin. Largely because I don't think it has a longer-term sustainable economics, and there's a number of reasons for that, and I can go into detail with that. But first of all, one of the reasons behind that is reducing the block rewards, and looking out 100 years, that would make that extremely complex to keep that sustainably alive. But that's just out 100 years. What I'm talking about in the next 10 years, what I think could occur is because Bitcoin mining is an economies of scale business, we're going to keep seeing diminishing margins across mining profitability. And what would occur beyond that is extreme centralization across these mining companies that would have the most capital to deploy. My answer to this question in short is I wouldn't put it into Bitcoin.
Okay, so for you, it's proof of stake versus proof of work, basically, is where the bet is.
I think proof of stake is a better system and more both economically and environmentally sustainable system. So I think proof of stake is a step in the right direction. There's probably a lot more technology issues that we still need to work out and some things to solve, but it's certainly a step in the right direction.
So I think that you have to segment it into groups and what you're looking for. I think Bitcoin got a lot of people into the space, and I think the macro argument, my partner Kevin Kelly excels at this at Delphi Digital. He just put out an institutional report on this. But the macro argument for Bitcoin is just very clear. It's easy to sell. It's sound money. It makes a lot of sense to people in developed countries around the world. It's very easy to understand, and it solves a lot of issues over the long term and bringing us into a world of a future of money. Now, on the flip side of that, you also have Ethereum, which I view as the absolute best intellectual petri dish of experimentation. Things are being built on Ethereum that I think will be extremely valuable over the next decade or 20 years that just aren't being built on Bitcoin. So I don't think you could discount one or the other and say, I like this and I hate that. I think they're connected in a lot of ways. But I think you have to keep in mind who your target audience is. If you're a 50-year-old retiree, buy Bitcoin. If you're a 25-year-old guy or girl that wants to build on the future of finance, buy Ethereum. So I think you have to decide where you fit into the space and then make your decision there. But it's worth pointing out that not just Bitcoin, Ethereum has just as many issues, if not more. But the point is that it has orders of magnitudes more developers than any other smart contract platform in the space.
Is the point of this question to choose one or the other?
Yeah.
So you can't balance a portfolio like anybody else in this room should? Okay. So if you were actually balancing a portfolio, I'd say it should be 80-20 Bitcoin. If you put a gun to my head, it's 100% Bitcoin because I have kids. And there's a pretty sizable risk in this migration to Ethereum 2.0 that many people just kind of wave their hands and say, our developer ecosystem is so talented, there's so much at stake, we're going to figure this out. The problem with that is proof of stake systems are not proven to work. So that's an existential type of threat. The reason that I think Ethereum 1.x right now, even if that was all that we ever had, is probably pretty good and maybe even good enough, is because you've got proof of work that's actually securing the blockchain and you've got these other financial incentives that are not just incentives held by the folks that already exist around the table. Proof of work works. It's proven itself over the last decade with Bitcoin and, by the way, in the last several years with Ethereum. So that transition, to me, is going to be, first of all, it's going to take a lot longer than anybody appreciates. I don't expect proof of stake and Ethereum 2.0 to happen before end of 2021 at the earliest. So I'm willing to put money on that. We'll see. And if you take that very long view, then proof of work is going to be the status quo for at least another couple, 2-3 years. The more likely projects to innovate on proof of stake consensus are probably not going to be Ethereum, specifically because there's so much less at stake in terms of the other infrastructure that's built on top. So between that and the opportunities that are unlocked by having things like Cosmos and Polkadots and other systems that are going to make it easier for people to migrate value from Ethereum to other smart contract platforms, maybe application-specific smart contract platforms, there is a risk that in that transition or leading up to that transition, a good deal of value bleeds out of Ethereum. And the last thing that I'll say is Bitcoin is very intentionally designed for a single use case, which can be very valuable. Back to my DeFi versus kind of Web 3 point. And the number of developers is not necessarily the most important proxy, the same way that the number of GitHub commitments is not necessarily the most important metric, because someone moving commas around in a GitHub repo is much less valuable than someone that's actually pushed a material change to a consensus algorithm or made an upgrade to transaction throughput in a safe, methodical, research-driven way. So Amin Soleimani has my favorite comparison for Ethereum versus Bitcoin right now, which is Bitcoin developers and the community in general seem to be more like the Spartans from 300 versus the Athenians, where there might be a lot more Athenians, but the Spartans are out there going, ooh, ooh, ooh.
So true. Yeah, there's this kind of sense in the Ethereum community that the platform with the most developers in the end will win, and that's not necessarily the case. So interesting what you were mentioning about proof of stake. That leads into what I wanted to ask next, which is the incentives behind proof of stake. I mean, incentives are, one of the, if not the most important thing behind consensus mechanisms. And in proof of stake, I mean, it's unproven, and some people say that the incentives aren't there for validators to stake their Ether and secure the network. Tom, I know you Delphi wrote a report up on this. Do you want to start?
Yep, so it wasn't just me, it was our whole team, all 5 of us, mostly more of the team. They wrote really deep dive on Ethereum, and the takeaway from it was that at the time, validator rewards and issuance wasn't high enough to attract enough validators to secure the network. The community has since somewhat of doubled the reward that they're going to put out there. So I don't know what it is now, 5.5%, 5% a year, something like that, depending on how many validators you have. But the point is that we can't move on with the space assuming altruistic developers and validators are going to validate the chain forever. It just doesn't work. People need to make money. They want to make a return. Eventually, everybody's crypto holdings are just going to be compared to what you could earn at a fund or stocks or bonds. So if Ethereum can't compete with Tezos on what you can earn on a yield, people are going to go to Tezos and validate that chain. The security is going to be higher. So the issuance and the inflation goes right back to security on a network. And all the smart contract platforms at the end of the day compete on security. So we have to make sure that the incentives are there on the economics to attract enough validators to secure the chain. And I think that the Ethereum community with their revision is moving in the right direction.
Okay. Do you have views on that?
Yeah, and as I mentioned before, I've done a great deal of work on ETH Serenity economics, and I've modeled out a pretty detailed model of becoming a validator from a large scale or a small scale using hardware, using software, using cloud. And what I've gathered is that probably if we're looking at yields between 2 to 5%, I estimate that from a hardware setup, that the number of ETH at stake would probably be between 8 to 20 million, respectively. And I think what that provides is a much more secure network and much greater resiliency if the price of ETH does fluctuate in a way that could impact the security of the network. That's the most recent change to the Ethereum rewards or proposal for proof of stake. I think is a great move, and that adds significant resiliency and almost down to lower double digits that would be able to secure the network in a great way, and it would cost a ton to actually 51% or hack or attack the network, which is obviously could provide the value for Ethereum and its long-term goals longer term.
Yield is not yield, though, right? It's just managing your dilution.
Sorry, I didn't hear you.
So in the transition to proof of stake, what gets thrown around as yield is not actually yield. You're just managing the risk that you're going to get diluted if you don't stake. So a lot of people are conflating these two things. In my eyes, the only way that you're going to earn money at scale in a proof of stake system by staking is if there's a sufficiently large fee pool that ultimately becomes a dividend stream of sorts for the existing holders. Otherwise, you're basically just staking to earn 5% of inflation, but if everybody else stakes, you're running in place. You're not actually earning anything because the total market cap shouldn't actually do anything. This is one of the issues that I have with not Ethereum per se, because there is a healthy gas market and people are using these applications, but for many of the other staking services and the proof of stake systems where people are talking about, you can earn 10%. No, you can't. You can earn like 10% to offset the 20% inflation in the system, so you're still losing net 10. I don't mean to split hairs, but I mean that's a pretty important difference between proof of stake and proof of work right now.
I mean, it's not 20% inflation.
No, not for Ethereum.
Not for Ethereum. I think it's actually below 1% inflation. And the yields that I'm quoting here are net yields. These are net of all expenses that you might incur as a hardware setup or as a cloud setup. I know that it's confused often that there are gross yields, just saying, oh, here's the rewards, here's how much money I would get to be a validator. But I think what a lot of people in this community forget about is the cost associated with validating that need to be accounted for into these net yields. And that's where I came up with that 2 to 5% to generate 8 to 20 million on the network.
Okay, that's interesting. So for you, net yield would be enough at this point to secure the network and be enough incentive to hold Ether.
Well, it's hard to compare yields against anything else. The only thing you can compare against is other smart contract platforms, which are not being utilized to the extent that Ethereum is being utilized, or expect to be utilized to a greater extent that Ethereum is going to be utilized.
Okay, so other concerns about proof of stake are that it incentivizes hoarding instead of spending Ether. And that it's centralizing in people who have the most money, essentially. What are your views on that?
So I don't think there's an issue with that because the people that control most of the network want to make the best decisions to further the growth of that network. So I don't see any issue there. I think it's worth keeping in mind for people new to the space that the difference between proof of stake and proof of work is now your ownership is tied to the security of the network. In proof of work, like Bitcoin, you don't have to own Bitcoin to secure the network. Run a full node mine, whatever you want to do. So there's a differential between proof of work and proof of stake that I think some people miss there. But as for who controls the most of the network, I think we've seen the Ethereum community make some really great decisions despite there being some very large owners in the space.
I'm not trying to be intentionally difficult. I just don't like panels where everybody agrees on everything. So
Disagree with me, Ryan.
that one I didn't disagree with. So I want to get to another question where you guys say something that I really think is just not right.
Just tell me what to ask.
So next question.
So you agree with everything?
Yeah, for the most part. I mean, I chimed in on how I feel differently about proof of stake, but just to elaborate on that point further, with Bitcoin, the cost of 51% attack the network is extremely high. It's in the many billions of dollars.
I estimate 2 billion.
It's much higher than that, and here's why. Because the global miners have capital expenditures far higher than that. And to 51% attack the network, you'd have to get a group of the mining companies to actually say, all of our CapEx is worthless. We just assume that everything that we've invested in for the long term is going to get bricked, and we're going to take this short-term path to jeopardizing basically the entire ecosystem and everything that we've personally invested in. I think the only way that that happens is if you're co-opted by a sovereign entity. So if the Chinese government came in and said, we now own your mining capacity, thank you very much for playing. We are going to exercise our right to seize all of your assets, and we are going to 51% attack the network. That's definitely likely. But the concept of someone being able to come in, even a massive hedge fund or a Dr. Evil sort of individual, it's just not going to happen with a proof of work system. And by the way, I think that is also true for Ethereum right now. But in a transition to proof of stake, it becomes much less costly to exercise that type of attack, specifically if you can exploit some of the staking services that are booting up to do this on behalf of their customers.
But I mean, $2 billion to the Chinese government is nothing, right?
It's 2 to 5
I'm saying
is what I estimate.
Well, I'm saying it's a difference between a sovereign level attack, which is, if it happens, it happens, and that's kind of an existential threat to any system. But The likelihood that as an individual or a corporate entity you could exercise some type of similar attack becomes much, much easier, I think, and we'll only see this, work in the wilds as some of these proof-of-stake systems actually come live, is much, much lower than you'd have in a proof-of-work system. That's not to say that proof-of-stake systems shouldn't exist. It's just that you need to understand the security trade-offs and understand that if you're actually trying to secure really high-ticket, high-value transactions, that might not be the best decision.
Ryan, I'm going to attack back.
We're talking, man. I'm not attacking.
So
you'll know.
Next year is a halving event. We've reached almost a physical capacity with mining and ASICs, or maybe not 100% physical capacity, but we are very near it. In the halving event, it's effectively going to have the hashing power. In essence, half the amount of costs it would take to 51% the network.
Well,
and that will continue to go on every 3 or 4 years.
Well, that assumes a few things. One, that there's no change in price. Two, that there is no fee market that ever exists. But I think the long-term assumption that you're making, I very controversially, I might add, agree with you about the long-term consequences of going to zero inflation in a proof-of-work system. I try not to say this at Bitcoin maximalist events because I would have to wear a bulletproof vest, but I do think that you should have inflation, some low level of inflation embedded into Bitcoin and other proof-of-work systems in the long tail so that there is a lower bound of seniorage that accrues to proof-of-work miners in addition to the fee market. Otherwise, you get really, really wacky incentives that I'm not sure anyone's really prepared for. Now, that's going to play out, and that's going to be like an epic battle in 5 years. I don't even really talk about it because people just yell at you on Twitter, and it doesn't really matter because no one's going to take it seriously until it becomes a problem.
Totally agree with Ryan. It's very hard to talk about what will happen and if a fee market will actually develop on Bitcoin to make up for block rewards, but I think it is worth noting on the other side that it's decades away, and the world will be a very different place then, and we'll have things like Lightning built on top, potentially, hopefully, that can make up for the fee market. But to Ryan's point, and I tell everyone this when I meet them, there is nothing wrong with investigating, running the math, doing the analytics. Will a fee market develop? What would inflation look like if it had to be impacted? Get involved and look at it for yourself.
Sorry, do you mind if I interject?
Shoot.
The one problem I have
now we're getting spicy. See?
Now
everybody's waking
spicy.
up a little bit.
The one problem
I told you I'd make it fun.
Is that Bitcoin is a decentralized, fully decentralized system. With that, it's a community dividing time when it is time for innovation. Bitcoin will forever be reluctant to innovate. It will remain at 3 transactions per second. And yes, you can build layer 2 type solutions that would help scale it. However, it will forever be reluctant to innovate. And if you try to implement a change to the system, you will divide the community, and that is longer term not sustainable.
How much more innovative do you want to get than reinventing money?
10 years ago.
It's literally the biggest moonshot of an idea that you could make for a technology, and the fact that Bitcoin's been very extremely narrowly focused on that, I think has been a large reason it's been so resilient to so many challenges that it's faced, so many things like a really hostile developer debate that happened a couple of years ago and then was since resolved. And by the way, I think with that as a guide, that's one of the reasons I feel so strongly about Ethereum, just focus, like the core developer community seeding the potential that Web3 applications are going to live on Ethereum. I don't think it's going to happen. And if more core developers just recognize that as a limitation and just focused on programmable finance, which is world-changing and multi-trillion dollars in value that could be captured and unlocked, but just focusing on that, like, that's good enough. And other blockchains will speak to each other, and you'll be able to have applications that sit on different rails.
Yeah, I think we're running out of time, but I think to summarize the sentiment of the panel, it looks like everyone here thinks that Ethereum 1.x at least will be good enough to be a platform for decentralized finance going forward, if not for the full Web3 vision. And then there's a little bit of disagreement whether Ethereum 2.0, how good it will work with proof of stake and the sharding and the different scaling solutions.
Thank you.
Thank you.
Thanks, Camila.
And can I just say, I do love Ethereum.
Bitcoin maximalist.
See you soon.